All right, let's dive into Clearway Energy's third quarter earnings call because, wow, what a report. To call this a simple earnings beat doesn't even begin to cover it. This was the kind of quarter that sends a jolt through Wall Street and has everyone scrambling to figure out what just happened. So let's break it down. Yeah, you're seeing that number right. The headline was a massive 376% surprise on earnings per share. I mean, how does that even happen? You just don't see beats of this size very often. And when you do, it means there's a really powerful story unfolding underneath. And you can bet the market sat up and paid attention right away. So, what does a jaw-dropping number like that do to the stock? Exactly what you'd think. The market gave a huge thumbs up, sending the shares flying up 6.6% in the next trading session and pushing it right to a new 52-week high. This wasn't just a little bump, it was a big, bold signal that investors loved what they were seeing. And just to put this into perspective, look at this chart. The consensus on the street was for about 42 cents a share. Clearway walked in and posted $2. That's not just beating the number, it's completely blowing it out of the water. It absolutely dwarfed even the most optimistic predictions out there.
Okay, so the big question is, how on earth did they do it? A headline number that big is great, but we want to know what was under the hood. So let's get into the nitty-gritty of what really powered this incredible quarter.
The cool thing is, this wasn't just one lucky break. It was pretty much everything going right all at once. For starters, the wind was literally blowing in their favor. Their wind assets performed way better than expected. Then you had their new investments already kicking in and adding to the bottom line. And on top of that, a lower than expected tax bill gave net income an extra little goose. It all added up to a really solid $385 million in adjusted EBITDA and revenue that also nudged past what analysts were looking for. Now, before we go any further, we have to talk about one key metric, probably the most important one for Clearway: CAFD. That stands for cash available for distribution. Think of it as the company's lifeblood. It's the actual real cash left over that can be paid out to shareholders. And one quick super important note, management is now using CAFD and free cash flow to mean the same thing. That makes our lives way easier when comparing them to other companies. So that was the quarter that was, but honestly, the most exciting part of the call was when management used this momentum to look forward. They didn't just have a great quarter, they're using it as a springboard for a really ambitious long-term plan. This is where the story gets very compelling. First, for the rest of this year, 2025, they took their full-year KFCD guidance and tightened it, raising the bottom end of the range. The new target is between $420 and $440 million. Now, that might sound like a small tweak, but in analyst speak, that's a huge signal of confidence. It basically means they're telling us, we feel really, really good about how this year is going to close out. And they didn't stop there. Then they dropped the really big news. Brand new guidance for 2026. They're projecting $470 to $510 million in CFD. That is a significant step up from 2025. It shows that the growth engine here isn't just humming along, it's actually picking up speed. And this timeline they laid out really tells the whole story. You can see the clear path they're charting all the way to 2030. They're shooting for around $2.70 per share in CFFD by 2027, and then growing that again to between $2.90 and $3.10 by 2030. You run the numbers on that, and it comes out to a compound annual growth rate of 7 to 8%. That's the kind of steady, visible, long-term growth that really gets investors to sit up and take notice. So a 7 to 8% growth target is pretty ambitious. Big promises are great, but the next logical question is, how are you actually going to do it? Well, the company gave us a pretty clear look at the engines they're going to use to power this plan. They have what they call redundant growth pathways, which is just a fancy way of saying they have a lot of different ways to win. It's not a one-trick pony. They can squeeze more out of their existing assets, they can buy new projects from their own sponsor, or they can go out on the open market and acquire assets from other companies. It gives them a ton of flexibility. And they're not just talking about it, they are doing it. Here's a perfect example. This brand new acquisition of the Deriva solar portfolio. Check out the numbers on this deal. For about $220 million, they're getting a huge portfolio with an expected KFD yield of 12% or more. That is an incredibly high return deal in this space. And once it's up and running, it's going to tack on about $27 million in extra cash flow every single year. So, what's the big picture theme tying all of this together? The CEO, Craig Cornelius, put it perfectly. He is talking about an emerging renaissance in the U.S. power sector. What does that mean? Think about it. All the new AI data centers, all the factories being built in the US, they are hungry for electricity. And Clearway is positioning themselves to be a go-to supplier for all that new demand.
Okay, so let's put it all together. After a blowout quarter and some really confident guidance for the future, what's our final verdict? Here's the official Talk Ticker's take on what we're expecting for the next call.
Bottom line, we are rating this an outperform. The growth story is clear, it's credible, and it's backed by a huge industry tailwind. We think the stock has more room to run and will continue to test those recent 52-week highs. So what's the number one thing to watch from here? It's all about execution. Wall Street will be watching like a hawk to see if they can hit those CAFD numbers they've laid out for 25 and 26. So, how might you play this? Here's our trade idea. The thesis is pretty simple. Clearway's 7 to 8% growth and smart acquisitions should earn it a higher valuation than the rest of the slow and steady utilities sector. So the trade is a pair trade. Go long Clearway, ticker CWEN, and short a broad utilities ETF, something like XLU. You're basically making a bet on Clearway's specific growth story beating the sector average. And history backs it up. Over the last year, Clearway has already outperformed that ETF by almost 9%. We think this quarter could help widen that gap even more.
And as always, this is not financial advice.